Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we're going to talk about mortgage rates. They plunged. They literally went from above 8 to below 7.5 for a very short period of time.
When you said plunge, I was thinking V-neck. Please continue.
Okay, and then we're also going to talk about a Moody's prediction, a price prediction. Moody's came out with a price prediction for
The excitement never ends.
Okay, this is the article. Mortgage rates plunge and demand finally inches back. There's been no demand, but it finally inched back, apparently. That's the article. I don't write this stuff.
Okay, so mortgage rates plunged. So they went from basically 8% to basically 7.5%. That's a plunge. Good. And demand, buyers, before there were 2 to 3 offers per property. Now there are how many offers per property?
I don't know if there's a lot more, but I actually have better data on the interest rate thing. So, okay, this is the quote. This is a quote from a different article. Mortgage rates have also largely been on the rise this year, peaking at 8% in October. Mm-hmm. So the end of October, they peaked, and then they briefly hit 7.4%. Now, remember, mortgage rates are tied to the 10-year.
Right.
So the 10-year kind of is adjusts to the market. Mm-hmm. So jobs report came out, it wasn't that great. It went down to 7.4%.
Well, so it was a couple things. It wasn't just the jobs report. The jobs report is what was the tipping point. But before that, it was that the Fed decided to keep interest rates the same because they felt that inflation was coming under control, that they were possibly facing some sort of a mild recession in the first or second quarter of next year. So They thought, well, all the interest rate hikes that we've been doing over the last year plus, it's finally working. So we're going to kind of stay the course and let it play out.
Yeah. Okay. This is the now. Remember, those were average rates. This was the conforming rate. This is a quote from the article. The average contract interest rate for the 30-year fixed mortgages with conforming loan balances decreased last week to 7.61 from 7.86. So it's 0.25%. It's a quarter percentage in a week change. Mm-hmm. That's pretty dramatic change from a Friday to a Friday.
Right.
That was a week over week. But remember, this is just the 30-year conforming.
Right. So if you were under contract to buy a house, leave us a comment. Tell us if you locked in one of those super low rates when rates briefly went down. We want to know if you were that fortunate or if you missed it by that much.
Would you believe? We do know that people are still buying down rates because only 3% of all mortgages out there existing are over 7. 97% are under 7. And remember, that only represents 58% of all homes because 42% are cash.
Right.
So really, you only have like 2% of all homes are financed with a 7 or higher percent interest rate, which is why foreclosures are the lowest ever recorded.
Right.
The foreclosure rate, everything. Okay, here's a quote for the article. Last week's decrease in rates was driven by the U.S. Treasury's issuance update, the Fed striking a dovish tone in the November FOMC statement, and data indicating a slower job market, said Joe Camp, Vice President, Deputy Chief Economist at the Mortgage Bankers Association. So you got a bunch of countries who said we're not raising rates anymore. The Fed had said, hey, everything's going good. This economy's flowing like we said it would. We don't think we have to do anything. The financial markets reacted to that, just like the stock market reacts when stuff is said.
Right. Good deal.
That's a good deal. Okay. Now before I read the next quote, let me ask you this question, Juana. We were told when interest rates were 3%, home prices were still 5 to 10% less than they are now. So home prices are up 5 to 10% from when interest rates were at 3% at the beginning of 2022. Why is it that interest rates have gone up to 8%, whoosh, but home prices have gone up 5 to 10%? That literally doesn't make sense because the Crash Bros told us that there's an inverse relationship to interest rates and home prices. Home prices have to fall, but they didn't. They went up.
Supply and demand.
Supply and demand.
Ding, 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 ding.
Okay, it's supply and demand.
Yes.
Yes, interest rates are a factor in supply and demand, but just one factor.
Right.
There's a lot of other things that.
Right, and then we also have very low inventory.
We have extremely low inventory.
Right, so which goes with that supply and demand. So look, we have low inventory. We still have buyers out there willing and able to buy homes, hence the whole supply and demand thing. And the bottom line is that because we still have lots of buyers that are willing and able to purchase homes, homes are still desirable. Homes are still selling inside of about a month. Homes are still selling. A third of them are close to, like 29% of them are selling above list price. On average, homes are selling for over 99% of asking price. That tells us that there's a lot of stability in the market. That tells us that there's a lot of demand in the market. That tells us that there's not excess supply. Because there isn't excess supply, because there is sufficient demand, it doesn't make sense to believe that home prices are on the precipice of crashing. I mean, it's not that it can't happen, it's just that the data is not there to support that.
Here's a quote for the article. Applications for a mortgage to purchase a home rose 3% for the week, but were 20% lower than the same week a year ago. I'll talk about that in a second. The decline in interest rates is still not enough to offset sky-high home prices, which are still rising due to the very low supply of houses for sale. So even though they acknowledge that their interest rates are super high, the low supply of houses is causing home prices to rise. Here's another thing. When you compare to last year and you say 20% lower than the same week a year ago, yes, interest rates were still in the sixes, high fives, low sixes this time. No, actually, they had hit 7.
They hit 7,
They hit 7. But the big difference last year, substantially more inventory.
Right.
In Vegas, we had almost 3 times as many houses on the market in November of last year than we do now, which is why year over year in Vegas, home prices are up like 6% from October last year to October of this year.
Right.
We had a ton of homes on the market compared to now. I think it was over 6,000. We have like 2,200 now. And there weren't as many buyers, and home prices softened from June a little bit. They were down like, I think, 5% or something. But now they're up year over year. We've been up year over year since, I think, July. Well, at least since August, we've been up year over year. August, September, October. The year over year in Vegas, we were up. But most of the country's up year over year in every market. I mean, most of the country's up year over year.
Right.
Now, Juana, let's talk about the home price prediction that Moody's had. What was they came out like literally this week with a price prediction.
Okay, so their name is well suited.
Moody, they're super Moody.
So, Moody people, no offense if you're a Moody person, I'm Moody, so it's all good.
She is super Moody.
So they came down with really long faces that home prices are going to go down over the next 2 years, 5% cumulative, and the sky is falling, and cats and dogs living together, and all kinds of mayhem. So I'm not saying that they're wrong on their number, because I don't know. I mean, none of us know, and they don't know either. But I just think it's funny that they just have basically the same recycle prediction every year.
Okay. So we're gonna okay, so remember the number. Moody's has probably everyone else is predicting home prices to go up for the next 2 years. Everybody's predicting it except for Moody's, okay? Moody's came out and said 5% decline over the next year's total. So they're nationally, right? Now, with that being said, I'm going to show you their 2022. Remember, this is the whole country. So here we go. Put up the chart. All right. Now, in 2022, Moody said from peak to trough, from the highest to the lowest, this was their prediction of home prices. Okay. Now, you see a lot of red, a lot of dark red. Look at Miami down there, dark red. They predicted 25% price decline in Miami. Remember, this is 2022. Boise, that was a market, certainly. The whole West Coast, literally the whole country. There's a couple like gray areas that are zero. Literally what Moody said is home prices will absolutely not go up. Remember, this is Moody's. They're responsible for rating bonds. Like they literally give bond. Remember the Big Short and housing crash? These were the guys telling you that the real estate, those subprime mortgages were AAA rated, right? And everyone's buying credit default swaps on them and stuff, okay? So look at this chart. Now, this is Moody's estimate, 2022, okay? Look how bad it is. So they're basically predicting 5, 10, all the way to 25% whole country, across the country.
Right.
Well, you want to know what actually happened in that same year?
Bring it on.
This is the home price shift between June 2022 and June 2023.
So the first thing you're going to notice is that minus 25% has now changed to...
The lowest was 10%, Boise. You can see it on there, 10.53. So they predicted Boise would be down 25%. They were only off by a lot, 15%. Like they're 15% off substantially. But look at Miami. Remember they said Miami was going to be down 20, 25%. Remember it was in dark red? It's in a very dark blue, probably up 8%. So they missed that one by 28%. Matter of fact, look at the whole East Coast, the whole Midwest, pretty much the South, except for Austin. Austin was super overbought and Boise was super overbought. The Phoenix area was a little overbought. Vegas was a little overbought. Salt Lake City was a little overbought. Some parts of the West Coast were a little overbought. But this looks nothing like the Moody's estimate. And this is the Freddie Mac's house price index, the year over year, what actually happened. Mm-hmm. So this is why I'm a bit hesitant to believe Moody's home prices down 5%. I think you could just, whatever Moody says, you can add 15% to. So we're gonna create our own index. We're just gonna take whatever Moody said and add 15%. It's like a handicap. They need a handicap. They're so bad at guessing. We just get to add 15%. So home prices will now be up 10% in the next 2 years, which is pretty much what every single estimator has predicted, 6 to 10% over the next 2 years.
Okay.
I just thought this was funny because when you read the article and you quoted that, and I said, I'm going to go find the charts because I think I remember reading something about that. I remember the chart and I went and found the chart because we have all these crazy charts and stuff. But I'm going to put the other chart back up just to show you really quick here. This is funny. This was Moody's estimate, peak to trough. This is what they said this was the housing crash. Literally the crash bros probably were having their own personal fun with this chart. They were probably sharing it with each other and stuff. And then that was the chart. That was Moody's a year. This was 2022. This article came out in 2022. Came out early in 2022, actually. As soon as they saw interest rates coming up, they came out with that. And this is what actually happened because this chart came out this year. So I think this chart probably going to look a lot like this in 2 years, except for them just be more blue and less red.
Right. The bottom line is, for basically everybody, it's pretty good. The economy's pretty stable. People have jobs. People's incomes are going up. People are able to make their mortgage payments. It's pretty good. It's not a bad way to go. I realize that not everybody's thriving, but no matter what the economy is doing, not everybody's thriving. There are always people who, for whatever reason, life has dealt them a bad hand, and we get that. But this is kind of showing us that, by and large, housing is doing really well in the U.S. This year, and there's nothing clearly visible on the horizon that is going to substantially change that. We've weathered the pandemic, we've weathered 7 and 8% interest rates, we've weathered a lot of things, and the economy's been resilient, people have been resilient, we've been adaptable, and this is just another testament to that, and that's a good thing.
Okay, I need you to put your mom hat on and give some mom advice.
Mom hat on.
To the people.
Yes.
There are a ton of people out there in 2019 who either were under contract or they were seriously considered buying a house, and they started seeing the crash bro stuff. We did the whole video of the 2019 where the guy literally went through great detail. It was a Seeking Alpha article, how the housing was getting ready to crash. Mm-hmm. And a lot of people said, I'm out then. Mm-hmm. Like this thing, these 3.5% interest rates, there's no way, these are way too high. These, median homes being $280,000, this is way too high. I'll just wait till they crash and then I'll go buy homes pennies on the dollar. Now they're looking, going, shit. I should have bought 30 houses when I had the chance. Now I can't even buy one, right?
Right.
What do you tell your children who are working, earning income, and they're trying to decide what they should do? What's the advice for an average person buying a house, what do you say? Like, how do you tell these people that want to buy a house or that will want to start building some wealth? What do you tell them to do besides like paying off debt and saving?
First, start out with a budget.
Okay.
And look, figure out your budget. Figure out how much you earn. Figure out how much you spend. Look at what you spend your money on. Does it provide you sufficient value? And value can be things like that your money works for you. So, for example, paying your car insurance. Obviously, that's valuable because then you're compliant with the law and you're protected against being sued and that sort of thing.
Okay.
Does it provide you sufficient value like other things? Like, for example, that Starbucks coffee, does it provide you sufficient pleasure, i.e. value, to warrant paying that? Or, can you make your own coffee, or can you find another beverage that's more affordable? So things like that. So go through, what do you spend your money on? And does it make sense? And then look at what your goals are. Write out your goals. If your goal is to be a homeowner, what will it take for you to be a homeowner? How much money do you need to put down? How do you save for that? How long is it going to take you to get there? What are you willing to do for that? Maybe you're willing to do some kind of side hustle to save up faster. There are lots of options for you, right? And then once you kind of figure out what your budget is and what your path is to home ownership, then get to it. Do what it takes to get to be a homeowner, because once you're a homeowner, then your life is on a different path than that of a tenant, right? Once you're a homeowner, then you are investing in yourself. You're paying your own mortgage as opposed to your landlord's mortgage. You get tax benefits. Your money grows at a faster rate. And what I mean by that is maybe you put 10% down on a home, but your home appreciates on 100% of that value. So you get to make money on that 90% that is the bank's money. So all kinds of good things happen to you and to your investment over time. Now, home ownership isn't for everybody, and home ownership doesn't make sense at every stage in everybody's life. And that's why I said, do a budget, have a plan, see what makes sense for you, and then execute.
In 2013, home prices had bottomed. They started climbing back up. And the original Crash Bros were talking about this thing called the shadow inventory. It was this mythical millions of houses that the banks had foreclosed that they were getting ready to dump back into the market and crash housing again. And it was a big deal. Now, remember, we were selling the bank-owned homes, so we heard about the tsunami of homes that were getting ready to come out. And our asset managers that we work with and all these companies were saying, yeah, there's all these other homes, yada, yada. Well, it turns out that what happened was a bunch of Wall Street firms went to Fannie, Freddie, and all the banks and said, hey, guys, don't let those homes hit the housing market. Put them in packages of 500 homes, et cetera, and we'll buy them from you. So what they did is they went around and started buying all the homes directly at a discount, directly from all the servicers. And they turned them into rentals. So the houses never hit the housing market. This shadow inventory never happened. A lot of people missed out on buying a house. And I think there was the 2017 or 16 was also another potential housing crash. 2019 was the housing crash. Of course, we've had 3 years in a row now, but housing's been getting ready to crash. And the bottom line is that everybody that hasn't bought a house in the last, even if you bought a house in 2006, back then was the top of the market. You would still be up 200,000 in Vegas on a median house over even though you mistimed the market as bad as you could, you'd be up 200 grand a day on that house. So my, suggestion is that you just take a look at, you get all the data, but if you have a good savings and have relatively stable income, just remember these interest rates aren't going to last forever. By the time interest rates do drop, it'll be harder to buy a house and they'll be more expensive because all the other people will come off the sidelines who've been accumulating cash going, now I'm going to get in it, it's affordable, and that house you've always wanted, you'll get overbid on.
Right. So what do you think? Does this make sense to you? Leave us your real estate related comments. We love hearing from you. Remember to like the video, subscribe, hit the notification bell, share the video, and we'll see you on the next video. Bye.
Bye.